Hello fellow traders. This video challenges traders to look beyond the AI narrative and examine where their actual risk sits on the chart. Since the start of this year, these two stocks have traveled very different paths. One has behaved like an AI runaway leader, while the other struggled to hold prior highs, making them perfect case studies on AI exposure and can mean very different things on your P&L. Through live examples in NVIDIA and CRM, we will see how the stock can have a great story but a poor technical location, and how that mismatch creates a bubble-style risk for undisciplined traders. Today, I want to help you stress your AI exposure. And everyone loves that thing, but few traders know whether they're in the right names or at the right spots on the chart. NVIDIA and CRM started this year under the same broad narrative that have taken many different routes. And that diversion is exactly what I want you to see today. By the end, you'll be able to look back on your portfolio and answer, am I actually positioned smartly in AI, or am I just riding the bubble wave? Today we're going to cover AI bubble risk. Are you all in the wrong names? By a pajama trader. Give this a like and let's get into it. When AI leadership starts to tire. So I'm going over this NVIDIA chart. We can see that at the beginning of the year, it started off with a big volume surge and then continued to have more volume on the run up. And then as it ran up, you could see that you had a gap up here, another gap up here, along with all of this selling into this run up. And it looks like you have a big volume sell here, which means that it's probably getting ready to fade, and it has, to here. And you have a recovery here, but not strong volume. So does this look like it's getting exhausted, or does it look like it's heading up for another uptrend? NVIDIA exemplifies AI leader that has delivered powerful price appreciation, but the structure now shows characteristics so commonly seen in late stage moves. A steepening trend line, candles stretching away from the key moving averages, and repeated pushes to new highs that demand surging volume. From the beginning of the year, NVIDIA has largely followed a strong trending path, printing higher highs and pulling traders deeper into the AI story. Even after sharp pullbacks, buyers have been willing to step back in near rising moving averages, keeping the bigger trend pointed up and leaving price not far from its 52-week highs. But that's why current extension and volume profile matter so much. The name is still viewed as a must-own, so many exhaustion can trigger sharp reset as crowded positioning unwinds. Look at the NVIDIA from the year-to-date perspective. It spends most of the year climbing that staircase higher, correcting, but never really breaking character. That's what true leadership looks like. Right now, it's still living near the top of its range, which sounds great until you combine it with the late stage vertical behavior and heavy volume. This is where I tell folks, a great company doesn't automatically equal a great entry. Here I'm more interested in protecting gains than chasing another marginal high. In this structure, I'd show you how you can trim 25 to 50% off of a swing into the vertical extension, raise stops under the last higher high or higher low, and for these using options, layer in a defined risk put spread as insurance. The teaching point is that we are not trying to nail the exact top. We're making sure that the single AI leader near its top of its yearly range doesn't control the entire P&L, even if it does get into a deeper reset. CRM, same AI story, different tape. So now we look at Salesforce, pretty much on the same time frame as NVIDIA. As you can see, in this year, it didn't really start off too strong like NVIDIA did. Then it had some volume selling along the way. And you didn't really have any big volume prints until you got to about September, which really only took it to 257. So even when it ran up to 366, it was on low volume. So like the NVIDIA chart before, does this look like it's recovering? Or does it look like it's going to do another sell-off when it hits the 271 to head back down? CRM is connected to the broader software and AI conversation, yet its chart reveals a different reality. A heavy volume breakdown from the highs followed by a series of failed rally attempts and lower swing highs. Since the year started, CRM's path has been much choppier, with earlier strength fading into deeper pullbacks and long stretches of sideways to down action. Rallies have repeatedly been sold, and prior support zones have failed to hold, leaving the stock shifting well below its yearly peak, while NVIDIA hovers closer to the top of its range. To 250, the 255 zone acts as critical decision area. Reclaiming and holding above it would signal buyers are regaining control, while repeated failure confirms capital rotating elsewhere. Now compare CRM, Salesforce, year-to-date chart path to NVIDIA's. It had moments early on where it looked like it might trend, but each push lost steam, and the stock has spent more time grinding down or sideways than making new highs. Today it's nowhere near its yearly peak, and that should force you to ask, if you're calling this AI play in your portfolio, what are you actually in the name? Are you in the name that's underperformed and the theme for our year? Well, for me, 250, 255 is the line in the sand. Without a decisive reclaim or hold here, this stays on my prove it list rather than buy the dip list. I'm not interested in blindly buying dips in CRM just because it's cheaper than NVIDIA. My rule might be that CRM has to close or hold above 255 on a growing volume before I consider a long. Instead, it pops into a zone on weak volume and stalls. And that's a live example of where I look at shorting exposure or put spreads with a clear stop above recent swing high. The lesson is to demand evidence of accumulation before committing capital to other AI names. Concentration, the hidden AI bubble risk. Bubble risk often appears not only in valuations of parabolic charts, but also in lopsided a trader's portfolio becomes when the single theme dominates. When one AI ticker represents a large percentage of total exposure, even a routine correction can feel like a crisis, pushing traders into emotional reactive choices. The fact that NVIDIA sits closer to the top of its annual range while CRM trades much further below its highs is a clear reminder that simply saying, I own AI names, is not a risk plan. Two tickers under the same theme can produce radically different equity curves over the same period, and your job is to know which path your capital is actually riding. At this point, I usually have everybody write down their AI positions, size, average cost, and then we classify each name. Its year-to-date path, more like NVIDIA's, strong and near the top of its range, or CRM's, choppy, stuck below prior highs. If one ticker dominates your pie chart and looks tired like NVIDIA, your risk is sharp as a sharp air pocket from elevated levels. If you maintain exposures like CRM, your risk is dead money or ongoing distribution while true leaders run without you. The goal isn't to scare you out of AI, but to show you exactly where your concentration risk lives. From AI hype to structured process. NVIDIA and CRM serve as reusable templates for analyzing any AI stock. First, classify the stock as trending and extended, distributed, and range bound, or neither, based on trend, volatility, and volume behavior over the year-to-date path. Next, mark exhaustion zones, support resistance pivots, and volume inflection points that will drive your risk-reward areas like NVIDIA's extension near the top of its yearly range, or CRM's 255 decision level wall well below its prior high. Finally, align position size, entry timing, and exit rules with classification instead of news flow or fear of missing out. Running each AI candidate through this checklist, plus a quick is this living in the upper half of its yearly range like Nvidia, or the lower half for CRM. Check builds that habit of grounding decisions in structure rather than a narrative and reduce the odds of being unknowingly all in on the wrong names at the wrong time. To wrap this up, I turn the charts into a drill. Pick 3 AI tickers from your own watch list. For each one, zoom out and decide, is it on the year-to-date path closer to the Nvidia's strong, high trend range, or CRM's choppy, low-range grind? Mark one key level where you cut the risk if it loses support at one level or another. Where you'd add or re-enter also proves strength. That simple exercise forces you to trade the actual path of the stock, not just the story attached to it. And that's how you avoid getting caught in the AI bubble while participating intelligently in the theme. Thanks again for watching.